Okay, what we're going to do is go over what was a little bit of a rough day in class today because I had a little bit of a lapse in memory, legitimately because the issue was from Chapter 3 and we're on Chapter 2, and I just sort of got faked into illogical thinking because I didn't have a good recall of Chapter 3 from prior times doing it. And so I apologize for that, but it's sort of a legitimate faux pas there. Was the issue. We had the issue of a contingency payment for the purposes of buying stock of a company. That contingency payment turned out to be $130,000. And the rule is that you record it as part of the purchase based on its present value. Present value is based on the probability of the payment coming to fruition. That was a 50% probability that it'll be paid at a 4% interest factor. That's the I for 1 year. And using present value analysis at 50%, the present value came out to 62.5. Problem told us that, and that's great. Then what happened is, in my thinking of what does that mean, I misspoke and thought that in terms of the parent-subsidiary relationship, that when it comes to consolidated, you're not going to show this liability. The liability would be on the parent's books at the time of the purchase. How so? Let's take a look. What the parent does is the parent credits cash for a purchase price of X dollars. It credits common stock for the purchase price of X dollars and maybe additional paid in capital if there is some in the entry. And so all this adds up to the total purchase price, and of course then they debit the investment account. This is what the parent does on its books for the purchase. And I think we've got that kind of concept under our belt. So when it does that, if there's a contingency payment, that creates a liability. In this case, it was 62.5, and the parent records the liability. And since their liability is part of the purchase price, it's part of their investment, the cost of buying the stock of the other company, the subsidiary. Okay, so that's all well and good to know that back here, the parent has this liability as part of his purchase price. My initial thought was, okay, well, that's intercompany, so it's not on the consolidated, but that's wrong because going back to this, who's the liability owed to? Well, let's take a look. The liability is owed to the shareholders of S, not S. So it's not an intercompany. It's a real true liability to outside people on the books of the parent. These are the people that the parent owes the money to. So that's where the liability lies, and it's a true liability of the consolidated that's owed to the shareholders of the subsidiary. All right, so that was the reason for that faulty thinking. And then so when we go back to here, what we have to then realize, and this is what we figured out in class by looking in the textbook, is that since it's really a liability, it belongs in the consolidated balance sheet as well. And that was the end of the discussion, and that made the worksheet balance. And we'll see that in Chapter 3. Again, I'm not sure I want to see it again in Chapter 3, but that's where we'll see it. And so now we know. Okay, that's cool. Let's take a look at one more problem, if we may. That's what I want to do now. We have the facts here. Let's go through it. This problem is a typical situation where there's a parent, and you can tell because it's Paris Company, and this is the subsidiary. Notice the P name and the S name to help us with the parent subsidiary. And by the way, that's how we should refer to it from this point forward. We're always talking now about parents buying a subsidiary, and the subsidiary remains a separate legal entity, and thus consolidation occurs. Okay. So having set that picture, let's see what the facts are in this case. We've got parent Paris buying Santa, paying $100,000 and issuing 10,000 shares of stock, par value 30. Market value is going to be shown here. So now we know the market value is $32 per share. Bingo, we're in business here, with only one exception on the calculator in front of me. So that should make this fun.
Let's see if I can pull that up while I'm talking. Here we go. There's the trusty calculator. Okay, so let's see what we got. First of all, let's figure out what else is in the problem. So let's take a look. We've got a situation where there's legal fees, $35,000, and accounting fees, in addition to stock issuance costs of $8,000. Now, from this class, we now remember very well what we do with stock issuance costs. That's going to go against the other paid-in capital at some point, APIC. That's what that's supposed to stand for. All right, so far so good. Really cool. Now, what happens next is we're asked to determine what the consolidated balance sheet looks like for all these accounts, including the retained earnings. I want to add that. And essentially what you would do is you would work this problem in order to come up with the answers that it's being asked for, and you would work it as a worksheet. And I'll tell you what, that's what you should do. And on the subsequent slide, or video, I should say, the subsequent video, I'll work through that, and you'll see the answer. So just give you a little bit of a, no, I wouldn't say challenge, because you should know it by now, but practice for next Tuesday's little exercise in class. And then I'll come back and give you the answer. So one of the things you're going to want to do, since this is only asking for the consolidated balance sheet on the date of acquisition, and all that information is given here, then you want to figure out, as well as everything else that's here, don't forget, and they sort of do remind you to compute the goodwill. The goodwill computation should be really just Chapter 1. We did it numerous times there, and so you should really be able to do that pretty readily at this point. Okay, so that's it. I'll come back with a second video to supplement and go through the answers here. In the meantime, you set yourself up with a spreadsheet and a worksheet and do it. Take care.